and I will then also now pass over to Shannon and David, and we are glad to be joined by expert trainers, both Shannon Santos and David Simantob. They are both partners at Wilson Elsa, and they will be taking us through the next 75 minutes towards your certification. So I'll hand over to you both now.
Thank you, Priya. I'm David Simantob. There we go I'm a partner in the Los Angeles office of Wilson Elsa. I'm here with my partner, Shannon Santos. She's the one with the big smile on the picture. We are happy to do this once again. It's part of the training requirement that everyone who basically touches California, and we're going to talk about that, has to go through. So you're going to be with us for the next 75 minutes to 4 hours while we go through this training session.
David, did you hear? Priya says we're supposed to test them.
Oh, we'll test. We'll test. We have a
Oh,
lot of really hard questions we're going to pose in the middle of this. So,
testing seemed to. Oh, and the other thing, Deborah Finch's email is not in the slides. I think it is in the email that will be forwarded to you afterward. But should we start?
yeah, let's start.
Okay.
All right. So one of the reasons everybody is here is California is an important part of the world economy, and for insurance claims, it's an important part of claims handling. So it's the fifth largest economy in the world. It has a population of only about, I don't know, 39 million. So it has a much smaller population than the UK, which is about 68 million. It has a lot of fun stuff. We have a lot of technology here, a lot of entertainment, a lot of other things, but we also have a lot of claims. People in California like to sue, the earth likes to move, the trees and the buildings like to burn. So uh, it has a lot of claims, and therefore you will see if you have anything to do with the United States in terms of your work, California, one way or another, is involved. And that's why we're here. So this is the first really, really difficult test that you pose. There's a poll question. So everyone just answer what you think is the correct question. Correct answer on it. Sorry. It's too early here in LA.
It is too early. It says it says I can't vote on this, but I have my opinions on what California's best known for.
All right. So since this is designed to make sure you guys are actually here and paying attention to every wonderful thing we're saying, let's see if I give it a few more seconds and then close the poll so we can see what everyone thinks. All right. Wow, well, everyone loves Hollywood, I guess, and that is certainly one of the more visible parts of California. Here in Wilson Elsa, we actually have a lot of claims involving Hollywood. We do a lot of entertainment coverage work. But in terms of claims, the exciting things are earthquakes and other natural catastrophes that we have. We have the fire season, we have the mudslide season. Silicon Valley is really important, and the technology industry is obviously happening. Nobody likes Disneyland. I'm shocked. That I think would have been Shannon's favorite thing to mark, or certainly my kids like it. Um,
I
it's
do
too
think
expensive.
that yes, these people coming over to California are not taking advantage of the tourist
Yeah.
things. If Disneyland didn't get a single vote.
Well, they said it's cheaper to go to Tokyo Disneyland than Disneyland in the United States, but who knows? So,
Sure.
all right. So let's go to the next slide and sort of tell you why we're here and what our agenda is. So we're going to take you through why are you being forced to listen to this discussion? What is the authority for requiring this training? What is it that the insurance regs, the Department of Insurance, will insist on this training? What do they hope to gain from this? There's sort of a biblical list of, like, thou shalt not and thou shall, so things to do and things not to do that we're going to go through. Um, we're going to discuss your time agenda. So things that you're supposed to do, you have to do it within a certain amount of time. I'm going to walk you through that. If you do things wrong or if people don't like you, there's a lot of complaints you're going to get, including to the Department of Insurance. That creates its own time agenda. There is a process for denying claims, that what you're supposed to consider and not consider, and how you're supposed to communicate it. Anything you communicate, you're supposed to document. We're going to talk about the importance of that. And then being, the 21st century, fraud is an important part of what you're going to deal with in the insurance context. And that has its own requirements and its own timeline, and we're going to mention those for you. Next. So why are we here? Why is this important? Well, first and foremost, it's required. The insurance regs and the Department of Insurance require that insurance companies adopt and communicate to their claims agents standards for investigation and processing of claims. And the reason these standards are important, not just because, they're good standards and it's important to follow them, but it's also important in the negative. If the insurance company fails to adopt these standards and fails to communicate them properly to their claims agents, then the failures of the agents, their delays in responding, or other violations of what the regs require, would be imputed to the insurance company. And that creates not is it just bad business and bad claims handling, it creates a huge exposure, both in terms of what the Department of Insurance may punish you for with fines, but also what you may face in a lawsuit, such as a bad faith lawsuit by your policyholder. Next. So who's required to do this? Licensees of the basically Department of Insurance. So licensees are all insurance companies, insurance agents, the brokers, the third-party administrators, the underwriting title companies. So these individuals, which includes hopefully everyone who is on this Zoom presentation, have to do this training once a year. Other people who help with the claims adjustment but are not licensed by the Commissioner or Department of Insurance don't have to do this. So who doesn't have to do this? Well, if you hire a private investigator, if if there's a public adjuster involved, or if you bring an expert on an appraiser to assist you with evaluation of the claim, those people are helping with the claim, but they're not involved in adjusting the claim per se, such as a licensee is. So they don't have to go through this amazing 75-minute experience once a year. Now, the licensees are not supposed to just get trained, they're supposed to get thorough and adequate training regarding all these regulations. So that means that we're going to take you through not just basically telling you what the regs are, but telling you why they're important and what's the consequence of violating them. So at the end of this 75-minute, you will be thoroughly and adequately trained, and the insurance carrier can certify that you, as their claims agents, have been trained regarding these regulations. The good news is Shannon and I, as attorneys, don't have to actually go through this training, but here we are doing it. So
And how come we end up doing this more training than anybody else?
yeah,
We're doing this like 6 times a year at this point.
it seems like it. Um, so the claim agents are required to do this. Who's a claim agent? Anybody who's authorized by the insurance company to investigate the claim. Anyone who's licensed by the California Department of Insurance to conduct investigations. The defense attorney you hire to defend your policyholder in a third-party claim is not required to do this. And as we said, an expert or an appraiser who's just giving a valuation of the claim, they're tangentially involved. They're not the type of claim agents or licensee who's supposed to do this. Next. Well, the training is also important because it's good business. It's good business because it helps you handle the claim correctly. These are all common sense rules that's good to follow. The other reason we do this training, and it's important to realize, is that the failure to have this training, the failure to comply with these rules and regulations has significant monetary consequences for the insurance company. So the Department of Insurance, through the insurance commissioner, is allowed to impose fines for violating the California regs. So each time that an insurance company commits an unfair act or practice on a consumer, the Department of Insurance can fine them $5,000. They can fine them $10,000 if the violation is willful. It's important that to remember that we're talking about each violation, not each claim. So in one particular claim, you can have multiple violations, each of them triggering a $5,000 fine. And these numbers, as we're going to discuss, can add up pretty quickly, not to mention create bad press for the insurance company. Next. So for example, these are some examples of violations in recent years that the Department of Insurance in California has imposed fines on various insurance companies. And, they range in terms of what the amount of the fine is and the total number. For example, picking the middle one, I guess, Farmers Insurance Company, this was 1,000 violations in 350 claims, so about slightly less than 3 violations per claim for delays, uh, including failure to communicate, failure to advise the policyholder that of their rights, including more time, that they could ask for more time, or that the carrier needed more time. And basically just failing to respond. The worst one probably was to the Department of Insurance, because the Department of Insurance doesn't like to be ignored. Sort of like, what was it, Glenn Close, to date myself. But anyways, that 1,000 violations only resulted in $1 million claim against farmers. It could have been, if you think about that, it's $5,000 per violation for unintentional violations. That number could have been significantly higher. On the right, against specific care, we were talking about 1 million separate violations in claims handling. It wasn't found to be intentional. It was found to be intentional because willfulness didn't require an intent to injure the policyholder. It's just that the insurance company was aware of the problem, given what its agents and employees knew. This resulted in a $91 million fine against Pacific Care. Again, it could have been significantly higher, because it could have been a $10,000 fine per violation, 1 million violation. My math is not that good to add up the total, but I think it starts with a B if they did it correctly. So, we're talking huge numbers. The other one on the far left is an example of how California treats this more seriously than other states. In that one, California awarded $8 million against Unum Provident for improper denials and benefit terminations. under the policy. Provident has settled its claims by 48 other states for just $15 million. California alone fined it for $8 million. So it fined it almost slightly more than half as much as 48 other states in total. So the fines in California can add up significantly. Next. The Department of Insurance is becoming more active. It's investigating California insurance companies for claims handlings. The fire is, that have been picking up more recently, more and more. Last year, we had the Los Angeles fires. Before that, we had a significant number of fires in Northern California. Those have resulted in major fines against insurance companies especially for failure in advising or communicating with the policyholder about replacement cost estimates and how that was calculated, how that was communicated, how the application was handled in providing extended replacement coverage, and how they failed to update replacement cost estimates after the policy was issued. These you can review. There was a market conduct exam done by the Department of Insurance in those 3 years. It resulted in a report. It's publicly available, and it resulted in not just fines, but forcing the insurance companies to pay up a lot more in claims because of these failures. So next slide, please. So as you can see, after the Department of Insurance investigated the insurance companies and noticed that they had failed to follow the regulations requirements in terms of communication and analysis and documentation of especially dealing with replacement cost coverage issues, they ended up paying back between $5 to $40 million in additional claim payments and disgorging and refunding premiums that they had collected. And this doesn't even discuss actual fines that the Department of Insurance may have imposed on them. So again, we're talking big numbers and bad press because this, got disclosed in the report by the Department of Insurance. Everyone got to see it. You don't want to see your name or your picture smiling in front of that report as the example of someone who's violated the rights. So these are some of the reasons why we're doing this. Next.
I saw a question on our thing that says that they're having problem viewing it on a web browser. And so I see your comment. I am not in a web browser, so I don't know if that's the reason, if that's why the slides aren't showing the full content. We did test it beforehand, so I think at least in the Zoom platform, it's working for everybody. I could stop sharing and reshare, but then we're going to have to skip all these slides to get back to where we are.
Well, unless a lot of other people are having the problem, maybe we continue. So one of the other important things to remember is California is a big state for bringing bad faith claims against insurance companies. While there is no private cause of action for simply violating the insurance regs, that means that policyholder cannot sue you simply and only because you're in violation of an insurance regulation. These violations can be evidence of bad faith when dealing with other conduct and as evidence of your pattern practice of or being in violation of your duty of good faith and fair dealing. Therefore, it is important to try to abide by these insurance regs, by their timeline, by their requirements, by their documentation requirements that we're going to go through to avoid Department of Insurance fines, damages, and bad faith claims against you. So just to give you an example, these are some of the things that California courts have found that an insurance company can be found to be in bad faith. And these all correspond to some insurance reg that addresses those issues. So uh, insurance companies can be found to be in bad faith if they unreasonably delay making a decision on providing coverage or providing a defense, for example, in a liability claim. That is why also the insurance regs have timing requirements as to when you're supposed to respond and communicate with your policyholder. Um, if you, California courts have found that if you fail to investigate promptly and diligently, or if your investigation is not comprehensive in what you're looking for, or you're being biased in what you're looking for, those can be evidence of bad faith. Again, the regs have requirements for what you're supposed to do in those regards. If your evaluation is not fair and objective, that can be found as evidence of bad faith. If you don't communicate adequately with your policyholder, that is evidence of bad faith. Again, communication and the timing of the communication and the content of the communication and the documentation of that communication is an important part of what the insurance regs require from you. And basically, it's sort of like the most obvious one. If you lie about what's covered and not covered, that's a bad thing. Don't do that. The regs say it, the law says it. So these are all reflected in the insurance regs. Next. So we keep talking about bad faith and how that, this is part of our, we scare you first, so you pay attention to when we actually get to the regs. But why is it important to talk about bad faith? Uh, if an insurance company is found to be in bad faith, it just changes the scope, the type, and the amount of damages that will be available to the policyholder against the insurance company. So if you simply breach the contract, you make a mistake, you breach the contract, but you're not found to be in bad faith. The policyholder is entitled to just foreseeable damages. Your policy limits still apply. If it's if you may owe defense fees, but you don't owe the fees incurred by the policyholder to pursue coverage against you. You may owe prejudgment interest, but basically the damages you are awarded against you are simply to compensate the policyholder for the claim. Bad faith exponentially raises the type and amount of damages available to the policyholder against you. They can get not just foreseeable damages, but unforeseeable damages. Your policy limits don't apply. They can get damages against you in excess of the policy limits. Not only in a liability claim or frankly in a first party claim, they can get their brand fees. So this is in the American system, usually each side is responsible for their own lawyer's fees. But in California, if the policyholder shows that you were in bad faith, they get their attorney's fees for pursuing the coverage against you for that portion that they spend in getting the policy benefits. And they can get punitive damages. Punitive damages is a multiple of their compensatory damages, so it increases the amount significantly. So violation of the regs can be evidence of bad faith, and bad faith can increase the exposure of the insurance company exponentially. Bad thing. Don't do it. Next. So to give you an example, these are some bad faith awards that were awarded against insurance companies so even if you're not normally dealing with third-party claims where you're worried about sort of social inflation and awards against your policyholders, you should realize that in a first-party claim, and a third-party claim, the question is not simply the award against your policyholder, but the potential exposure of the insurance company for violating the regs, its obligations against the policyholder, and being found in bad faith. These damages in California and in other states that have similar rules are huge. The numbers are getting bigger. The California one, for example, the insurance company did not pay the full value to cover the damages after a home was flooded. The policyholder got $18 million. The home was not worth $18 million. I can guarantee you that. It was so And the numbers just keep getting bigger and bigger. In Nevada, which follows California rules quite often, it was $100 million award. In Indiana, 112 million. So these can be huge, huge numbers if you're found to be in bad faith. Next.
I think you did an adequate job of scaring them, even though 18 million doesn't mean the same it used to. So now that you know the consequences of not following the regulations, now we're going to go into the actual rules to make sure you get trained. This is the part that I'm sure you remember hearing at least once a year for every year you've been handling US claims. So my apologies if it gets repetitive. The regulations are set forth in the insurance code, and they are set forth as 16 prohibited practices. In order to get them written as a negative, they sometimes write them in double negatives, and it gets really confusing. So we've tried to streamline it into things you should do and things you shouldn't do. And as noted, they are only providing an administrative remedy. This is not a violation of the regulation, does not give the opportunity for the insured to pursue the insurer directly. This is work that the insurance commissioner then does to control the insurers to make sure that they're following the regulations by imposing those fines David was talking about. Regulations set out the minimum, and so it's important to note that you can still be found in bad faith even if you've complied with doing the minimum. I'm sure you guys all know, like, you're supposed to be responding to the insured within 15 days. Well, if you're doing it on the 15th day every single time, maybe that comes off to the court as not reasonably handling the claim. So this is the minimum you can do to make sure the insurance commissioner does not come after you. Of course, you want to be doing the best you can with respect to each insured claim. The idea is obviously to make settlement of the claims fair to the insured. But the less common sense reasoning for these regulations is actually supposed to be to benefit the insurers. It's supposed to be providing them an opportunity to monitor these claims to see if there's fraud and to report those claims that they find to be fraudulent. The idea is the closer you are paying attention to the claim, the more likely you are to find fraud, the less likely the insured is to try to commit fraud. So it's intended to benefit both the insured and the insurers. There's two different ways you can find to have violated the regulations. You can either do it knowingly or through pattern and practice. The knowingly we spend less time on because we do not believe any of you are knowingly committing violations of these regulations. Instead, the reason this comes up, the reason you get millions of violations in those cases David was talking about, is because the administrator finds it to be a general business practice as reflected through just a pattern of doing this over and over again. So if you have the wrong date associated with the time you're supposed to respond to the insured on one California claim, chances are you're going to repeat it on the next one. And if you're doing it on every single claim, then you have a general business practice of violating that regulation by getting it wrong in each individual situation. Now, the knowing can be done through implied or constructive knowledge, and that's where that Pacific Care found that the information that was held by the agents was enough to make it a willing violation on behalf of the insurers. So the London market is going to be held responsible for what the TPAs are doing in the US. And if the TPA is knowingly committing these violations, then the insurer will also be hit with that $10,000 fine per violation. So these are the 16 rules, things to do, things not to do. We are going to go through them, even though I am sure you know them and I expect you're doing them on a regular basis. Obviously, you need to be responding to communications with the insured. If they give you evidence of a claim, a covered claim, if they tender a claim, you have to affirm or deny within a reasonable period. We talked about having reasonable standards for investigating and processing those claims, making sure that there's a procedure put in place for handling them. You have to make fair settlements when liability is reasonably clear. If requested, you have to advise as to what coverages the payment is being made. Obviously, the payment under one type of limit might impact the insured differently than if it was in a different type of limit. You have to settle promptly, and you can't reference any other settlements with respect to that one particular settlement. You have to provide the basis upon which you're denying a claim, and we will go through the things you need to put in a denial letter. And then, less commonly used, but it is written into the statute, you have to pay AIDS benefits within 60 days. Things not to do, David said, don't misrepresent the facts and policy terms. Again, common sense here. We don't want to be lying about anything to the insureds or claimants. You can't compel an insured to sue to recover benefits, and that will open yourself up to bad faith liability. You can't attempt to settle for less than's due based on the information that the insured provided. You can't attempt to settle based on an altered application. Again, probably not a common part of your practice. Same with telling claimants you don't like, you have a practice of appealing arbitration award. You can't require the same information to be provided on multiple forms. And in some situations under emergency declarations, you can't require it on the forms at all. You can't tell the attorney or the claimant not to get an attorney. And you can't mislead the claimant as to the statute of limitations. Rather, in most cases, you're actually required to affirmatively tell them what the statute of limitations would be. So, those are the 16 you've heard over and over again, things to do, things not to do. There's also a different part of the regulations that specifically were added to avoid discrimination based on race, gender, sex, national origin, physical disability. Again, not something that we expect anybody listening to this would be doing, or the TPAs that you're having run the claims, but it is written into the codes as something that cannot be done. So we talked about all the bad things that can happen if you have bad faith liability. And so now we want to talk about how to avoid it. And these are our best advice. Obviously, communication. The more you are talking to the insured, the less upset they're going to be. Even if you're telling them, I don't have anything new to tell you, at least they are less likely to complain because they at least know that you're paying attention. It's like attorneys, where the most common report to the state bar is that the attorneys aren't responding to communications. This is the same thing. The insured just wants to be kept up to speed. They want to know what's going on. They don't want to have to check in with you to see what's going on. We're going to talk about the timing, the 15 things that need to be done within 15, 30, and 40 days. Keeping up with those, again, minimizes your potential for fines because you're in compliance with the regulations. And you're also, again, limiting bad faith liability because you're staying on top of the claim and showing the insured that you're staying on top. Continuing to do this throughout the claims investigation is always a best practice. And it's our recommendation that you just provide as much information as is available when you're reporting to the insured or the claimant about this. There's not really, unless you're suspecting fraud for some reason, there's not a reason to be holding back information. Tell them everything you know, tell them what you're waiting on, tell them what information you need to get from other sources. And then that way they are like, okay, at least something's happening. I know the adjuster is handling this, and they're less likely to check back in. All of the timing requirements start with the notice of claim. And it's when there is a notification to the insurer or the agent, again, because it's imputed to the insurer, that reasonably apprises the insurer that a claim is being made. Now, it doesn't have to be written or in writing unless the policy requires it. It can be reported over the phone. What is reasonably apprised? I use the example if an insured calls and says, does my policy cover water damage? Then no, you probably are not reasonably apprised that a claim is being made against the policy. They're just asking for coverage. If an insured calls and says, my water heater exploded and my basement is flooded, does my policy cover water damage? Then you probably are reasonably apprised that there's a claim and your trigger dates have started. This is why we recommend anything that's going to an agent be immediately reported to the insurers, because again, the insurers are going to be responsible for responding within a certain period of time, and that's based on when the agent receives notice of the claim. You have 15 days to respond. We know that most of the London market is responding, targeted to respond within a day, have the TPA reach out within a day of the notice. That's great. Again, this is minimum, the regulation is the minimum standard, so you can always be doing better than this. Next day notifications on it or acknowledgments of the claim is great. We recommend you do everything in writing, especially with respect to the acknowledgement. Anything where you're trying to show that you have complied with the regulations, it is easier to prove if you have done it in writing and it's in the claim file. So try to get everything done that way. Encourage your TPAs to do it that way. And if for whatever reason you're not following you're acknowledging the claim but not in writing, then make sure it's at least documented in the claim file so you can then go show that you did it within the 15 days. Within those 15 days, you're also expected to provide the insured with any forms they need to fill out, instructions they need. You have to give them a copy of the regulations. And this, we say this particular statute in 12-point font that is usually attached to the back of an acknowledgement letter. It's also strongly encouraged that you begin investigation of the claim, because you will see later, not doing anything from the immediate start of the claim does not buy you more time later. So the sooner you get started, the sooner the TPA starts asking for information, the better. Now, the 15 days continues through the life of the claim, and anytime the insured makes a request on which the insurer would be reasonably expected that a response is requested, they have 15 days. There is now, again, what is reasonably expected to do a response. I use the example that we've had people reach out to us, screaming at us, telling us that, we're in bad faith and not handling the claim properly, and that we should quit our jobs and all that kind of stuff. Do I think that reasonably expects a response? Probably not. I'm not going to say within 15 days whether or not I'm quitting my job. But if they reach out and say, what is the status? That's going to reasonably be expected that a response is expected, and you have 15 days. Now, this does not apply once there's legal action involved, and then the lawyers get involved and they're talking to each other. We still try to stay within those 15 days when we're helping with a claims investigation, because it's easier just to show that the insurer through their attorneys are also responding. 15 days.
And your obligations under the policy still, even if there's a lawsuit against the company, the obligations to handle the claim still continues. It's just that this 15-day rule doesn't apply. But your other obligations about how you investigate and document the claim still continues. Sorry.
Now, what information do you have to give them? Again, you have to give this complete response, and it's based on whatever information you know. You're not expected to have finished the claims investigation. You're not expected to have an answer. You have to give them whatever information you have that responds to what they are looking for. Within 40 days of the proof of claim, and we'll talk about that, you have to accept or deny the claim. 30 days for medical disability. Again, this part needs to be in writing. Then once you have accepted the claim, I've got the hiccups, you have 30 days to then pay. This can include any undisputed payments. So if you're investigating the claim and you find, okay, this portion of the water heater busted, the basement's flooded, we know the mitigation services are going to be covered. You have 40 days to accept the mitigation services, and then 30 days thereafter to pay, even if the rebuild is being questioned and you have to wait for more information on that. So it's whatever portion of the claim has been shown through a proof of claim. When you are accepting or denying a claim in a first party context, you have to give the insured notice if you intend to pursue subrogation against somebody else, against the plumber who installed the water heater. They just have to know that subrogation is a potential outcome. Actually, David and I just did a whole presentation on subrogation and salvage. I can like stick that whole thing in there on that one bullet point. Now, proof of claim is when the insurer has been provided documentation that shows that there's evidence that the covered claim, that evidences the magnitude of the damage. So again, it's any portion of it that shows that the amount has been established. Now, it can be a continuing obligation to provide that evidence. For example, if you've got ALE claims going on, the wildfire 2025 Palisades and Altadena victims are, still getting paid out their ALE monthly. You can continue to require them to provide evidence as the claims investigation continues. But once the evidence is provided, then that triggers the 40 days to accept or deny and 30 days thereafter. If at any point in the future the evidence shows a different result, you can make a different claims decision. This is not holding you to anything. Again, it is trying to keep you on track of responding to the claim as the insured provides evidence. We know in practice this is not going to get done within 40 days. So obviously additional time is permitted so long as you have a reasonable basis for doing so. So within that first 40 days, you then provide a letter to the insured saying, here is the reason why we have not made a decision. Here is the information we are waiting on. And here's when we expect to get a decision to you. The reason cannot be, we are just now starting to look at this. So that's why getting the TPA and the IAs started earlier is better. So then you have a list of what information you still need. If the 30-day letter can go with a list of requests for information you need from the insured. Here's the information we're waiting on from you. And then you can be working on your claims investigation through these additional time letters. And the insured gets a status update every 30 days thereafter, stating why a claims determination has not yet been made. All right, so here's our next poll question. Our testing, apparently we have to test you. And this is funny because we actually designed the poll specifically so that there is no answer. So we'll see how you do. All right, so a claim comes in from a highly litigious law firm, and we have plenty of those in California, saying that there's interior water damage as a result of rain. Now, the claim comes in saying that the wind damage occurred 8 months prior. Now, what is your primary concern with handling the claim? Given the likelihood that this is going to result in a bad faith lawsuit, since counsel is already involved and probably was involved before the insured decided to make a claim. The need for an inspection to see if there is evidence of wind-driven roof damage. The difficulty in evaluating the impact of storms from 8 months ago. Or just the investigation of the insured's regular roof maintenance. David and I used these poll examples from all cases we have in our practice. And we had one specific law firm in mind and coming up with this one. And this was very common. They were going door to door. They were telling the homeowner, oh, you see that broken shingle up there? I think that was from that roof, from that wind event we had 8 months ago. You should hire us to file a lawsuit, bring the claim, and then file the lawsuit. And unfortunately, I think they worked to their disadvantage because they were filing so many claims at the same time that the insurance company was just like, well, clearly these are not real claims, and spent all their time investigating and trying to prove, start investigating these claims to show that this law firm was creating these claims just by going door to door, handing down flyers, that kind of thing. All right, let's go ahead and close the poll and see what people would start as their primary concern. All right, so most is difficulty in determining the impact of storms 8 months ago. I agree. Now, the insured is going to be the one who has to bring the claim within coverage. It's their burden. So they're the ones that have to. And this law firm in particular started giving us weather reports from 8 months ago, trying to show what the wind strength was at that time. If they can then pull up that documentation, it's hard for us to say otherwise. Nobody's going to remember what the wind was like 8 months ago. Second is Need for inspection to see if wind-driven roof damage. Agreed. Send the IA out there immediately and start seeing if this is a wear and tear issue or if it actually was wind-driven. Now, mind you, I made a water damage claim from my roof recently and it was denied as wear and tear. And I fought back and I was like, this was wind driven. And I pulled up my weather reports and I said, this is where it came from. So it is entirely possible the insured pushes back. Bad faith suit, honestly, it's just always going to be a risk. I'm more surprised that nobody said regular roof maintenance because that's where we're focusing our effort. We're trying to show that this is the result of wear and tear, and because of that, we're questioning them in discovery and in deposition, saying what maintenance were you doing to the roof during your time of ownership to show that they weren't regularly maintaining their roof. Whereas I then told my insurance company that I had just had the roof replaced a year ago, and so obviously it was not okay. Okay. David, you can continue on with the DOI complaint.
There we go. Thanks, Shannon. So, Shannon took you through some of the regs and the requirements, their timing requirements and the content requirements of when you're supposed to respond and what they should include. Some of these timing and content requirements change when there's certain suspicions or concerns. Either someone has complained to the Department of Insurance against the insurance company, or as we're going to talk about, the insurance company has concerns about fraud or other issues against the policyholder. So let's talk about the more important one, because this is one where the Department of Insurance actually does pay attention to. Often the policyholder would complain to the Department of Insurance. That's why actually in our position letters, we tell them they can reach out to the Department of Insurance, be required to do so, and this we're going to talk about. When the Department of Insurance lets you know that they want a response and to a complaint, you have 21 calendar days to give a written and complete response to the Department of Insurance. You can ask for extensions. They usually give it, but don't hold your breath. Go ahead and try to put the response together as if you're bound by that 21 days, because without an extension, you are. Usually, the Department of Insurance asks you to produce your claim file because they will review it and they'll see what you've done. So all these things that we've been talking about the timing, the documentation, the content of your communication, that's the kind of stuff the Department of Insurance will review. Now the claim file that's produced to the Department of Insurance will redact your communication with your coverage attorneys, Shannon and I, but the other stuff will be there. So the Department of Insurance wants, more than anything, wants to see that you were responsive, both to them within the 21 calendar days and to your policyholder within that 15, 30, 40 time deadlines that Shannon pointed out to you. The content is also very important, but the timing is the easiest one for them to catch you on, and that's important. It's because they will review that and they will talk to you about it and find out why didn't you follow the rules. So that changes the timing, and it's important to know that the Department of Insurance complaints have their own rules and response time. Next. Now, if you believe or suspect fraud by your policyholder, which we're going to talk about, it's a lot more common these days, that changes both what you can communicate to your policyholder and the timing of it. So you don't have to disclose information that may alert them that the claim is being investigated for fraud. If there's a reasonable basis, there's some specific information that the Department of Insurance can double check, then your time to act on the claim is increased to 80 days. So instead of the 15, 30, 40-day rule, you have 80 days. If you report the fraud to the Department of Insurance and you make a diligent attempt to figure out if the claim is really fraudulent, then your time to respond is suspended until the Department of Insurance tells you to respond. So depending on the level of suspicion and of fraud, and your timeline can increase or be completely suspended. That's why fraud, it's like being bad, it's important to realize. And the content of it you give will change. Next. So when you choose to finally take a coverage position and you go ahead and say, okay, I'm going to deny this first party claim, there's the timeline we talked about, but there's also the content. The content is you have to include all the reasons for your denial. If you have a factual reason, oh, this was just wear and tear, it wasn't wind-driven rain. The legal reason, if there's case law that says, for example, the smoke in the found or the ash found in the house is not property damage because it can just easily be wiped out, you should give those reasons. If there's a statute, there's case law, there's an actual policy provision, be as detailed as you can to explain the basis and the reasons for your coverage position to the policyholder, because somebody will double check it. At some point, someone will challenge it, either in a court of law or by the Department of Insurance, and you want your position to be self-explanatory and a single document that gives the most detail and explains why you are right. And frankly, the more detailed you are, the less likely somebody's going to push back on it and say, no, I disagree. And then at the end, like we said, you're supposed to, every time you deny a claim, you're supposed to give the policyholder notice that they can complain to the Department of Insurance about you, which is sort of nice, come and get me kind of a notice. Next. So where does this Department of Insurance notice go? The statute sort of says you're supposed to put it when you deny a claim. Our position has always been that even if you issue a reservation of rights, you should include it, because a reservation by definition is saying that there were some portions of the claim that may not be covered. Who do you send it to? Send it to your policyholder, to the additional insured. If they're represented by counsel, in your communication to their counsel, you include it. If they have a public adjuster or someone acting on their behalf, you include it. Basically, in my view, if it touches California and you're reserving rights, questioning something, denying something, anything that in any way potentially could be viewed as somehow limiting an outright payment of the claim in full, you should include the Department of Insurance. It doesn't hurt. Basically, just, right before you say sincerely your name, right before that, right above it, just say, you can call the Department of Insurance and complain about me. We'll give you the actual language you need. So, but basically that's what it says. Next. So when you investigate a third-party claim, it's slightly different than a first-party claim, and it's important to know. Usually you start with a review of policy and the complaint. In California, you are entitled to look at facts extrinsic to the complaint to see if they create or deny or help you deny coverage. But you are not supposed to affirmatively conduct discovery that could prejudice your policyholder in the underlying case. And then California law says once you make a coverage decision and say, okay, I'm going to deny this claim based on my review of the policy, the current complaint, and the evidence that, the extrinsic evidence I'm aware of today, I'm going to deny this claim. Then you're done. You don't have a continuing duty to keep investigating. If something changes, the policyholder must give you a copy of, for example, the new complaint or the new discovery response that says, okay, something you relied on has changed. Now look at it as a retender and evaluate coverage. Next. So in responding to the third-party claim, there are certain no-nos as well, that the regs don't like it when you try to say, okay, I'm not going to settle this claim against you because I think somebody else should be paying, not me. You have an obligation to settle the claim. If somebody else is responsible, then bring a subrogation claim against them or bring a contribution action against them. Now, the policyholder is not entitled to pay more than, entitled to one full payment, not double payments. So you can coordinate if another carrier is also paying some parts of it to make sure there's no double recovery. But you can't just say, well, I'm not going to pay until somebody else pays. You're not supposed to leverage your power to settle the claim to try to lowball the policyholder and pay him less money and say, okay, that actually can be used as evidence against you if the offer you make to the claimant is viewed as unreasonably low. You can condition the settlement of a claim against a policyholder in exchange for the policyholder not complaining to the Department of Insurance or frankly not suing you for bad faith. Your obligation to handle the claim is independent of the right of the policyholder to exercise the rights they have to complain to the Department of Insurance or sue you for what they perceive as bad faith conduct by you. And once you say that, okay, I owe this judgment or I'm going to pay this settlement amount and it's covered under the policy, you have 30 days to pay it. And unless there's some discussion or agreement to extend it by some reason. Next. So the lowball offers are a problem in both third-party and first-party claims. The regs say that no insurance company shall attempt to settle a claim by making a settlement offer that is unreasonably low. If in a first-party claim, the Department of Insurance will compare your initial first-party settlement offer to the final offer that you made. And if the delta exists between those two numbers, you better have a really good explanation. Otherwise, the department will say that your first offer was clearly unreasonably low because at the end you ended up paying a lot more. Now, in a third-party claim, is a different standard. Is the test is whether the amount you offered is what a reasonable person with the same knowledge about the case would have offered. So it's a lot more wishy-washy. It's not an exact number comparison. But again, the key is don't try to lowball the case. Try to evaluate it and offer a reasonable number when you try to sell it. Next.
This I think is my favorite video on the whole PowerPoint. David doesn't care too much about pictures. You put any text on there, he can talk for an hour. He doesn't need anything on the slide. So I'm the one who always wants to put in the pictures. And I love this guy. I love this video. And now I have to give time for everybody who was off doing something else to switch back to see my video before we move on to the next slide.
It's a cute video.
Not that nobody's paying attention.
Okay, so we talked about fraud and how that changes the timeline for responding. Shannon and I have presented a couple of times on the impact of insurance fraud on insurance claims and verdicts. The reality is that fraud is a real existing problem in the United States, probably worldwide, but in the US it's been, and in California, it's a hot topic right now. The estimate is 20% of all insurance claims are fraudulent. It costs in the United States something like $300 billion a year. The number keeps increasing. That $300 billion is from a few years ago, so the number right now is a lot higher. Something like 20% of car drivers admit to lying about their claim, trying to pocket the money for themselves, or lie about, trying to get a lower premium. Some states, it becomes really evident, like Arizona is a very tiny state by population, is less than 2% of the US population. For some reason, 10% of all auto glass claims in the United States were in Arizona, just because people suddenly everyone's auto glass was breaking, quote unquote, and they were getting a lot of money. So these are things that allow you, if you suspect fraud, like we said, it changes the timeline. If you have more than just a suspicion, you have some actual evidence and you're investigating it and you report it to the Department of Insurance, it suspends your timeline. So it is important to pay attention to fraud. It saves money to the insurance company. And really, one of the purposes of the insurance regs is to not just help the policyholder by getting, prompt and accurate communication from you, but by forcing you to pay attention to the claim and, review it frequently and communicate about it frequently. It allows the insurance company to catch fraudulent claims and other problems with the claim. So it's important to realize fraud is a real problem. And part of the reasons the regs exist is to allow the insurance companies to deal with that fraud issue. Next. So what does fraud do? Fraud increases the expense to the insurance companies, obviously. It increases the cost of repairing dealing with the claim. Insurance companies withdrew from certain markets because the amount of fraud that was going on was ridiculous. Some states were having trouble finding any kind of, for example, homeowners insurance or auto insurance because carriers started withdrawing. It increases and it's a problem for the policyholders because fraud by bad policyholders costs everybody money. Everyone's premiums goes up. There's less insurance available. Uh, you know, it's good for the lawyers. We get to sue more and go after these bad apples, but otherwise it just costs money for everybody. Next.
And I think fraud litigation is really hard. I think trying to prove something's
It is difficult.
fraudulent takes a lot of effort.
All right, so as part of our continuing duty to test you, here's the next poll question. So there's a lawsuit against your policyholder. The claimant makes a time-limited demand to settle. You get the demand. What is the information you think is the most important in order to respond to a third-party settlement demand? Are you going to ask the defense counsel for evaluation of the claim? Are you going to be worried about the deadline and how fast you should respond? Are you going to go ahead and read the statute? So Section 999 is the pre-suit statute for pre-suit demands, but it has language that we believe applies to even suits during the lawsuit. So
Yeah, the last time we gave this presentation, I put one of the options to be worried about is, or to information you want is the discovery responses that were provided. And in real time, David pointed out to me that this is a pre-suit litigation demand, thus there would be no discovery. So I remembered and I took that off your option this time.
well, and then we change this to a lawsuit against the insurer, so this is no longer a pre-suit demand.
Fine, I'll change it for the third one.
All right, so let's see what everyone thinks about this.
He also acts like he doesn't pre-approve these polls before they go up. He has seen everything.
Right. So I would tend to agree with the first choice, the deadline posed by the claimant, because depending on where you are in the lawsuit or whether you're in a pre-suit demand, the deadlines are important. You don't want to miss the deadline because then if the deadline was reasonable or pursuant to the statute, you can be deemed to have rejected the demand and open up your limits if the judgment against your policyholder is higher. Your defense counsel's evaluation is really helpful. If your defense counsel says, look, I don't think this case is worth that much money, that's basically a free get out of jail card because you can have a reasonable basis to say, I relied on defense counsel to deny it. The language of the 999 statute is also, I think, very important. It is a statute that came to existence for dealing with pre-suit demands. It is a very helpful statute in terms of it allows you to ask for more information without it being viewed as a rejection. It allows you to ask for more time without it being viewed as a rejection. And while it expressly deals only with pre-suit demand, our view has been that it expresses the view of the California legislature that that kind of behavior is reasonable. So we think that following its requirements in a lawsuit against your policyholder in responding to demand is also a reasonable thing to do. So everyone did well. Yeah, let's close this. Okay. So Shannon mentioned this. You have some other communication requirements to your policyholder. If there's a statute of limitation, you have to notify the claimant 60 days before its expiration. If the notice of claim is first received by you within that 60 days, you have to notify them immediately. If they have an attorney, usually you don't have to tell them in a third-party claim, but in a first-party claim, so the most policies have a 1 year or 2 year suit limitation period within them. The first-party claim, you have to tell the policyholder regardless of whether represented by counsel or not. And it's important because Shannon and I have a lot of cases where we are moving to dismiss the lawsuit against the carrier because they didn't file it within 1 year. That we've had cases where we wanted to do that and we found out that the carrier never gave notice of the time limit to the insured, so we couldn't do it yet. And so it is a powerful weapon in claims against you if the policyholder delays bringing suit, but it only exists if you've communicated that information as you're required to do by the regs to the policyholder.
That actually just reminded me, those MSJs we're doing on the 1 year suit limitation right now, I need to go check to make sure they put that language in the coverage
Yep.
position letter. We've run into that problem at the pleading stage, and the summary judgment, I usually focus only on the fact that I can use any of the documentation that I want as opposed to just the pleading. But it does need to advise them of that limitation period to respond. Document in the claim file, we talked about it. Everything should be in writing. It's just easier. It's easier on you. It's easier on your attorneys. It's easier on the DOI. Put everything in there. Make sure you can recreate the events. The claim notes should be documenting everything that happens. Anything that's getting sent to the insured in writing should be put in the claim file as opposed to just being saved via email somewhere else. So the idea is to be able to recreate the timeline to show all the places that you complied with the regulations if asked to do so. The DOI has the right to be examining all your files. So they want to be able to see, like David said, the timing, when you were doing things. Sometimes even if they're just looking at the dates, even if they're not looking at the content, the dates will let them determine whether or not you were complying with the regulations. You have to be able to keep the claim data for a certain period of time. Obviously, anytime you're accepting or denying a claim, you want that well documented. It's our general rule that if it's not in the claim file, it didn't happen. You're not going to be able to prove it happened. It's going to be the adjuster saying, well, it would have been my practice to call the insured to say this, but they're not going to remember what happened a year ago. So everything, and encourage your TPAs to put everything in writing. Now, putting everything in writing leads to other problems. Obviously, that there is common documentation issues, including replying all in email, using inappropriate language in email. I would say the goal should be anytime somebody is communicating with the insured, you have to assume that that document is going to get blown up and put in front of the jury. So you need to make sure that it's respectful. Don't say, even if you think these things about the insured, don't put them in writing. That's what phone calls are for. If you go ahead and have just an informal discussion, if you meet with somebody and you talk about a whole bunch of different claims, make sure that you're writing in each individual claim what you decided. You're not going to be able to, again, remember all those different things you had. So you need to be able to go back, put any discussions you had orally and put it in either, at least in the claim notes, something that can be recreated. You're also going to have to turn over most of this information through discovery. If federal court, you're going to have to affirmatively turn it over because you're going to be relying on the claim file. State court, they're most likely going to ask for it anyway. And if the DOI audits the insurers, they need to be able to recreate the claim timeline. So everything needs to be in there. The attorney-client privilege also becomes an issue with respect to what information is in there. So basics. Okay, attorney-client privilege is a communication between you and your attorney that you expect will remain confidential. We note here that TPAs often report through a London broker. Now, depending on the state you're in, that could be a waiver of the attorney-client privilege because it's not directly between the attorney and the client. There is a third party who's involved, and the London broker is not necessarily seen as the direct agent, whereas the TPA probably would be seen as an agent of the insurer, so communication with the TPA is going to be privileged. But if you're then disclosing that communication through the London broker, it's possible that the privilege gets waived. Not so much in California. California's got a pretty strict attorney-client privilege standard. But we raise this because, it's Wilson-Elser's position that for coverage matters, we direct report to London, and that's part of the reason. We don't want there to be a question as to whether or not the attorney-client privilege has been waived. So keep it in mind with respect to your attorneys here and how you're having them communicate with you. I'm going to go through some of this really quickly because I know we're running out on time. We kind of talked about how you prevent fraud with respect to the claims handling. It can start at the underwriting process. Make sure you're asking the right questions. Know what the insured is, what their business is, what jurisdiction they're in, what type of case law is coming out of those jurisdictions, and what type of jury verdicts are. And then that way you can guide your writing of policies in a way that's going to limit potential fraud later. Communicating, investigating, we talked about all this, avoid unreasonable settlement offers. You have more tips as the claims, or more tools to prevent fraud as the claims investigation continues. For first party claims, you can take the EUO, and it's possible, like you can be taking different types of witnesses. So you can be getting multiple sessions of testimony under penalty of perjury that you can use to then investigate the claim. You can be requiring, obviously, the documentation, but you can also have them sign a proof of loss under penalty of perjury. Gives you another opportunity for them to hopefully not submit a fraudulent claim and be more truthful in the information that they are providing. For third-party claims, you have litigation tools available. You can do that. You can look at through the discovery, the litigation hold letters, anything that's being produced through discovery. You can hire investigators. One of the attorneys in our office was just telling me a story about how he's a defense attorney. He used a private investigator to follow around the key witness and ended up with very incriminating photos that he kept telling her at deposition, you can't lie, don't lie. I'm telling you, this is in your best interest. Don't lie. You are under penalty of perjury. And she lied. And then he showed her the photos, and there's nothing you could do at that point. So private investigators can be a useful tool as well. There's a lot of anti-fraud technology out there right now. AI is obviously a big part of that. This stat, 60% of insurers already use AI to combat fraud. I expect that's going to go up considerably as well. The use of drones to inspect properties is becoming very prevalent with respect to homeowners claims, commercial property. Obviously, all of this can help you to investigate and hopefully prevent fraud from occurring in the claims. Obviously, you just want to be on top of it. You want to make sure that somebody is paying attention to these things and investigating the claim enough to know that there's a potential fraud there. Also, you have affirmative litigation options. You can affirmatively bring a DJ action to determine whether or not a claim is covered, a rescission action to rescind the policy if you think that there's a misrepresentation in the application or in the claims handling. Then you have different ways to use fraud as a defense to a bad faith action. Usually the policy is going to say if there's fraud in any fraud with respect to the insurance policy, that the claim is not covered. So, and again, what I said earlier, frequent communications lets them know that you're paying attention and they're less likely to be trying to pull this stuff. All right, that's it. As we noted, you will have a certificate mailed to you in a few weeks. Then you want to hold on to it because if at some point you need to prove that you took the training, such as having your deposition taken, you're going to want it available. We are available to stay on if anybody has any questions. Otherwise, we are more than happy to answer questions via email. You can
There's
anytime.
there's one question on the chat about the California claims management being easier with strict regulations compared to other states. Um, I think so. Shannon and I both handle a lot of claims in other states in the country, in the United States, and both the regs and the case law in California are there's a lot of guidance as to what you can and cannot do. So while it puts a lot of restrictions on your conduct, it does give you a roadmap as so you don't have to guess at what is the appropriate course of conduct for some things. So in a lot of other states, there's just not a lot of guidance that you don't know, is this going to be okay or not okay? So in fact, I know a lot of insurance companies, even in other states, affirmatively choose to follow the very strict California standards because they view this as sort of almost like a fail-safe way to meet uh, proper conduct even in states that maybe have less guidance or looser standards.
Cheers. Thank you for that, David.
Sure.
And once again, a big thank you to both Shannon and David for conducting today's session. If you do have any questions, again, please feel free to drop myself an email or Deborah Finch as well, and you will all receive your certifications in the next 2 weeks. And yeah, thank you again, once again.
Thank
Thank
you. It's
you.
our pleasure.
Thank you.